By 2026, artificial intelligence has become the most powerful word in finance. Every earnings call mentions it, every startup claims it, every stock with even a remote connection to AI seems to attract massive attention. From Wall Street to retail investors, everyone wants exposure to artificial intelligence. But behind the excitement, a growing question is starting to worry serious investors. Are we witnessing genuine technological progress, or are we building another financial bubble that could eventually burst? This isn't the first time markets have fallen in love with a revolutionary idea. History has seen this pattern before, with railroads, the dot-com boom, cryptocurrency manias, and countless speculative trends in between. Each time, innovation was real, but expectations moved faster than reality. Today, AI sits at the center of global finance, and the speed at which money is flowing into anything labeled AI is raising red flags. In this video, we're going to break down what an AI bubble actually means, how it forms, how it affects financial markets, and whether we're truly heading toward a crash or something more complex. When people talk about an AI bubble, they're not saying artificial intelligence is fake or useless. In fact, AI is one of the most transformative technologies ever created. The real concern is valuation versus reality. A bubble forms when prices are driven more by hype, fear of missing out, and speculation than by actual financial performance or sustainable profits. In the case of AI, many companies are being valued not on what they earn today, but on what investors hope they might earn someday. In financial markets, narratives are powerful. When a convincing story takes hold, capital moves quickly. Right now, the dominant story is that AI will change everything: productivity, jobs, profits, and even how economies function. That story isn't wrong, but markets tend to exaggerate timelines. Investors often price in decades of future success within just a few years. When that happens, even good companies can become dangerously overpriced, not because they lack potential, but because expectations become impossible to satisfy. One of the clearest signs of a potential bubble is how markets react to the word AI. Companies see their stock prices surge simply by announcing AI initiatives, partnerships, or vague future plans. In many cases, these announcements add little clarity about revenue or long-term strategy, yet the market responds instantly. This tells us something important. Investors are often buying the idea of AI, not the underlying business fundamentals. Capital allocation has also shifted dramatically. Venture capital, institutional funds, and retail investors are pouring money into AI-related stocks and startups at unprecedented speed. This creates a feedback loop. Rising prices attract more attention, which attracts more capital, pushing valuations even higher. Over time, this disconnect between valuation and actual performance becomes fragile. The moment growth slows or earnings disappoint, the same enthusiasm that drove prices up can reverse just as quickly. For investors who lived through previous market bubbles, the AI boom has a familiar rhythm. During the dot-com era, companies didn't need profits, they needed a website. During cryptomanias, projects didn't need utility, they needed a white paper. Today, many companies don't need proven AI revenue, they just need the label. This doesn't mean all AI companies are bad investments, it means the market has stopped being selective. In every historical bubble, real innovation existed. The internet did change the world. Blockchain did create new financial tools, but not every company survived and not every valuation made sense. When reality eventually caught up, strong businesses survived, while speculative ones collapsed. The danger isn't investing in AI. The danger is assuming that all AI exposure is safe simply because the technology is powerful. If an AI bubble were to burst, it likely wouldn't look like a sudden overnight collapse. Instead, it would unfold gradually. Earnings reports would start missing expectations. Growth projections would be revised downward. Governments might introduce regulations that slow deployment. Costs associated with AI infrastructure could rise faster than profits. Each of these factors would slowly chip away at confidence. Markets don't crash because technology fails. They crash because expectations fail. When investors realize that adoption takes longer, margins are thinner, or competition is more intense than anticipated, prices adjust. The most overhyped companies suffer the most, while firms with real cash flow and sustainable models recover faster. This kind of correction can feel like a crash to those who bought at the peak, even if the broader technology continues to advance. While some investors chase headlines, experienced investors are becoming more selective. Instead of asking whether a company uses AI, they ask how it uses AI, whether it improves margins, reduces costs, or creates defensible advantages. They focus on balance sheets, revenue quality, and long-term scalability rather than hype-driven momentum. Smart money also understands cycles. When excitement peaks, risk is highest. That doesn't mean exiting markets completely. It means managing exposure carefully. Diversification, patience, and discipline matter more during hype phases than during fear-driven downturns. The goal is not to predict a crash perfectly, but to avoid being overexposed when expectations inevitably reset. The truth is uncomfortable for both extremes. AI is neither a guaranteed golden age nor an inevitable disaster. It's a powerful transition phase. Some valuations today are clearly stretched, some expectations are unrealistic, but the technology itself is real, and its long-term impact is undeniable. This means we may not see a single dramatic crash, but rather a series of corrections, rotations, and revaluations as the market learns which AI businesses deserve premium pricing. In many ways, the biggest risk is not a market crash, it's investor behavior. Those who blindly chase hype tend to suffer the most. Those who understand cycles, manage risk, and focus on fundamentals tend to survive and compound over time. Every major financial innovation creates both opportunity and danger. AI is no different. The technology will reshape industries, but markets will continue to exaggerate, correct, and repeat the same emotional patterns they always have. The question isn't whether AI will succeed. The question is whether investors can separate long-term value from short-term excitement. AI doesn't eliminate risk, it exposes impatience. And in markets driven by hype, patience is the rarest advantage of all. If this video helped you see the AI boom more clearly, like the video, it helps more people find grounded, no-hype finance content. Subscribe to the channel if you want deep dives into trends, bubbles, and real-world investing psychology, not just headlines. Drop a comment and tell me, do you think we're in an AI bubble or just early in a long cycle? And if you know someone chasing AI stocks without understanding the risks, share this video with them. It might save them from learning the hard way. More breakdowns like this are coming, and the next one will challenge another popular narrative.